All right, we just got started. August 13th. My name is Brian Wilson, for those who don't know me. Thank you very much for joining me today. It's always a pleasure to be with you. Just a couple of rules to think through before we get started today. It's meant to be an interactive session, so feel free to send me items on the chat line. Raise your hand if you want to. We'll try to get to whatever questions that you might have. I have a number of topics as we get going today. If you would just mute yourself during the discussion itself, that would be very helpful. Otherwise, we'll go ahead and get started. Hi, Candice. Great to see you. Well, I'm going to start with present conditions for broad market sentiment and big tech. I think I have 5 or 6 topics today, and then we'll touch base with whatever is of interest to you guys. So let's start with broad market, and some of these will be review concepts. I won't spend a lot of time on them. I just want to make sure that I'm hitting them for new participants. So when we talk about broad market sentiment, sentiment is our algorithm for demand in the marketplace. It's here in green. You're looking at the S&P 500 right now, and I'll bring this back a little bit so you can see what the cycles look like in the market. It's very normal to have supply and demand cycles, and we've had, I think, 5, maybe 6 so far this year. What I'm referencing is times that we move above 6 for market structure sentiment. You see a red line here, and you also see a green line. Now, normally for this time period, right through here, so from the time that we move above 6 to the time that we move back below 6, it's about 9 trading days on average. This is going back over the last 6.5 years. It's about 9 trading days. And the way to think about it is market returns just flatten out. We average about 60 basis points during that 9-day period. And you can see it right here. You know, we get up to the red line, market returns flatten out. We get up to the red line, market returns flatten out. Same thing happened here. That was back in April. Now you'll have a flattening out, and then sometimes you can explode higher afterwards. That's also very normal, but hit the red line. We actually ended up moving lower there for a period, flattened out this period. Well, look what happened this period. Once again, we flattened out. So it's exactly what normally occurs. No outliers right now in terms of this particular sentiment cycle. And now I will talk about one potential outlier in terms of sentiment, but I'll hold off on that until a little bit later in the discussion. Let's go over to big tech for a moment. Big tech is hot, just like the broad market. Once again, for those that are new, the big tech components comprise about 35% of the market cap for the S&P 500, so we pay attention to it. When big tech is doing well, and you can see the correlation here, this is a pretty strong correlation. Big tech sentiment starts to move higher. This was almost a perfect bottom, and you can see how it turned out over here. Big tech starts to move higher, broad market starts to move higher. It's not always that way, but when you comprise 35% of the S&P 500, it's going to impact things. Right now, big tech is up to 8. I mentioned that particular dynamic because over the last couple of years, I've been tracking, I guess it goes back to 2024. So when big tech gets above 8, what happens to the market? Similar exercise. Big tech moves above 8. Big tech moves back below 8. How long does that take? On average, about 4 days. What's the return during that period? Basically flat. More negatives than positives. And then if we circle back a week later, what's the market doing? On average, it's moved higher. So once again, it's that principle of the market just flattening out for a period of time. We're seeing it both from a broad market sentiment perspective, and we're seeing it, I think, from a big tech perspective as well. Let me stop for a moment, see if any questions have come in. I don't see any so far, so we'll go ahead and continue with our discussion. The next discussion point I want to talk through is our model portfolios. If you're on the email distribution, this was the email that came out from me this morning. It comes out at about 5 o'clock Mountain Time. Really, the only prerequisite to be on it is that you're a regular client. And I'm not sharing my screen, am I? Sorry about that. I do that once in a while. Move back, admit one person, and share my screen.
That bird there.
Email distribution on a daily basis, it comes out at about 5 o'clock Mountain Time. And this is what it looks like. And you'll see each day, you'll see currently we're listing what's called the Core Focus Passive Portfolio. There's other ones that I'll show you here in just a moment. Just as a reminder, a prerequisite to getting on the list, just send me or Tim an email. And we just need to be a regular subscriber, please, not a 1 month trial subscriber. That's the only prerequisites. When you click on this, it will take you to all of the model portfolios. And we actually have 5 of them right now. So Tim has been doing a lot of work behind the scenes. I'll show you what these are looking at. Some of them you can tell right away. Focus passive, that's our principal portfolio at this time. It focuses on passive investment as the name tells us. The contrarian fund doing just the opposite of what we would normally do. It's actually performing pretty well. I mean, you need to know what you're getting into. I'll show you some of the criteria and performance here in just a moment. Momentum fund is as it sounds like. Focus Fives is as it sounds like. This is one of our better performing portfolios right now, and it's literally just 5 holdings, and it's held those same holdings since July 9th was the last time that we had an exit there. So a very stable portfolio, and this one is as it sounds like as well, focusing on mega caps. Let me show you what these portfolios look like. And I have no rhyme or reason here, just the way I pulled them up today. Focus Contrarian Fund. And the criteria is interesting because it's looking at, let's call it distressed equities. It's looking at sentiment below 2. Normally you would not be purchasing something below 2, correct? Well, in this fund, we're doing just the opposite. We're purchasing bad sentiment, and we're purchasing high short volumes higher than 60%. And look at what's happened. Look at the chart here. Look at this performance from May going forward. That fund was down with the broad market, started to rebound in May, and it's rebounded by about 40%. And if you look at the overall portfolio performance from May going forward, I mean, that's incredible. 42% versus 7% from the broad market. Once again, that's May 1st going forward. So I present that to you as an option. Is it dicey? Yes, it is. Maybe that's a small portion of your portfolio if you decide to go, with a route like that. Let me show you the other ones. Edge Momentum is performing the way that you would expect momentum to perform. This stretch right through here from July going up to the end of August was a very strong momentum period for the market, and for this fund in particular. We look at year-to-date performance. It's up to 34% for the fund, and compare that to the broad market. That's up. Sorry, is this year-to-date? Let me see what this is. Sorry. From June going forward. Okay, so what we're looking at here is June going forward. This has performed up 13% versus the market at about 2%. the performance chart for the year has this particular one at 34%. So that's Edge Focus Momentum. The Edge Focus Passive is the one that we distribute every day. This is what it currently looks like. Like the Momentum Fund, it did better in that stretch of really good momentum. We've had a little bit of difficulty finding passive investment holdings. And you can see that the fund has struggled a little bit. It's stabilized here over the last week and a half or so. So two other ones to quickly show you. The Focus Fives. This one is probably would be our top choice at this particular time. I'll show you why. There's essentially no turnover. The last time that we had any movement out of this one was on July 9th. But since, once again, get you the numbers here, since June 2nd, compared to the broad market, 13.6% versus 1.9% for the market. So that's exceptional, and you're not having any churn in the portfolio really to speak of. And then the last one is our Focus Mega Cap. And this one, I think, is holding, let me look at the criteria. I think it's 5 holdings. Yep. Fund count is 5. So a little bit like Focus 5, but it's just looking at the mega cap space, and it's outperformed 16.2%. And we look at the broad market performance of 13%. So depending on how you want to shape your portfolios, you have 5 different choices here that you can go with. Currently we would lean towards that Focus 5.
Hey, Brian, quick
Yeah.
question for you.
Yep, absolutely.
So these percentages, basically what you're saying is each of these portfolios or these funds, as you're calling them, if you equally distributed your money across all the members of each of your funds, so these percentages would say that's what's required. Is you'd have to, like, if there's 10 members, you'd have to have 10% of whatever money you put into each of them to get these returns. Is that kind of what you're saying?
Whatever your, I'll give you an example, Barry. Okay. I haven't traded in these funds for a little while. I've been concentrating on the daily names. But when I would just put $2,500 each in each one of the allotments, and I would treat them equally. Yeah.
Okay, that's what I thought.
Yeah,
that makes sense. And entry and exits and so forth. This is just buy and hold, basically, these percentages. So it's not getting in and out. It's like a long-term buy.
Well,
and hold.
It depends which fund you're talking about. The Focus Fives, yeah, that doesn't have really any turnover. Like the passive portfolio is moving out of names every day and moving into other names. So you do have turnover in that one, and some of the other ones as well.
So what drives, are we going to look at each of the portfolios that you put together and see when you get in and out of each of them and use that as a trigger point of getting in and out? So we model what you're modeling on your portfolio.
Correct. Let me share my screen. Great questions. I'll give you a couple of examples here. So the Focus portfolio every morning, if you're following along with that one, get the right email up. It will tell you what to get out of and what to get into. So if you were doing the Focus Passive, you would want to exit Cisco, Netflix, etc. You can see it has some turnover every day. And then those are the names then that you would want to then get into. And then that would be your current holdings for the day. But if you don't like turnover, then maybe you go to that Focus 5. Do I have it up? Focus Fives. Once again, with this particular portfolio, the last time we had any turnover was July 9th. So it just doesn't have very much turnover. It's a little bit slow and methodical, but over time, 13.6% versus the broad market. This is what it's looked like here over the course of the last, that's since the beginning of June.
And so do you send those notes out? Does it come out at the end of the day, before market open in the morning, or?
It comes out before the market opens, so it'll come out about 5 o'clock Mountain Time. So then these exits are based on the previous day's close, just so you know. It's the only way that the model can figure out the numbers. So the exits are based on the previous day's close, and the ads are as well. Over time, we found it evens out. So, the exits will be whatever Cisco closed at yesterday. The ad will be whatever SPY was today. But then sometimes you get better exit prices when you exit today. Like I said, it evens out over time. But this just tells you then what to do the next day.
Do you recommend when these come out and so forth, do you recommend putting any stops or anything, just for your downside protection, or do you just say stay in and until?
It's your discretion.
Okay,
Also recognize that it's not looking out for any events. It's not looking out for
right.
earnings. It's not looking out for any of those things. We'll try to give you a heads up. We can't write on all 5 portfolios every morning. We basically just write about the focused passive each morning. But if we see something outstanding, like, I'm making this up, but hey, Dell had earnings yesterday. Just be aware of that.
Right.
Because you'll get names sometimes that are up 15%. You don't want to buy it when it's up 15%. So you
Yeah.
have to use a little bit of discretion from time to time.
Okay, great. Thanks. Appreciate it. That sounds
You're
good.
welcome. Yep. So those are the 5 different portfolios. Once again, any questions, feel free to let us know about that. This morning I spent a little bit of time, and it's worth reviewing here just for a moment. I won't spend a lot of time on it, but we have just a very calm market at this particular time. So this was the note this morning, and part of what the note was triggered from was what is occurring right now in the SPY. So this is our sister company, but I just want to show you what's happening in the SPY at this particular time. So if we drop down to look at intraday volatility, and what we're describing here is the movement between lows and highs during a given trading day. Volatility has basically disappeared from the market at this particular time. 50 basis points versus 200-day volatility of about 1%. You've probably noticed it the last week or so, the whole market's just kind of come to a standstill. You look at the market at 10 a.m. in the morning, you look at it at 12 p.m., like nothing's happening. And that's why intraday volatility has moved so low. That's all well and good, but let me take you behind the scenes for just a moment to just describe some of the hidden dangers or just what's going on beneath the surface. So what we start to see is the fact that arbitrage opportunities start to shrink. So the fast traders, the ETF brokers, they're not making as much money as they were before. Market makers are going to start to hedge less aggressively. That intraday volatility compresses. I showed you what that looks like. Investors can become a little bit confident, a little bit complacent. The risk premia starts to decline. So that return that investors require as compensation for taking risk, that whole risk premia starts to decline, and the market just becomes increasingly fragile to an unexpected shock. I went back during the last year this morning, and I looked at the times where the market has had this. What I'm talking about is intraday volatility that has just shrunk, and I compared it, and I looked at the number of instances that's happened, and specifically I was looking at 50 basis points below the 200-day average. So with that as the criteria, uh, my question was, how long does it take for the market to fall by 1% when we have that type of setup? The average is 10 days. So within a 10-day period, the market tends to fall by 1%. And actually, that 1%, it falls by more than that. It's happened 4 times over the course of the last year. and the returns are negative 1.74% on those days. I bring that up, and I pointed it out right here. It's a risk. The market is very complacent right now. It's all well and good, but there usually is some type of triggering episode then in the next couple of weeks where you do have returns of 1% or worse for a given trading day. What can we do in context of that? And I mentioned it here in the divergence. That likely means that we'll have a big down day in the next 2 to 3 weeks. I'm going to continue to trade from the daily ideas portfolio. They're great ideas. They give you the percentage of the time that they work. I love to just stack them by percentages here. I'll then drop them into a watch list. I like to trade the last 10 to 15 minutes of the day. Ideally, I'm looking between entry low and entry high. I'm not looking for ones that are under a ton of pressure because sometimes if you start to get pressure in some of these names, that means that it's no longer working. And I don't want to go past the entry high because then I'm chasing things. So this is kind of the sweet spot to look if you're trading in those names. Now, part of my recommendation, and please, this is just me, um, since I know that there's a good chance of a volatility event in the next couple of weeks, I'm going to continue to trade, but I'm just going to reduce my total number of positions just in case I have one of those volatility days. And let me give you an example. And I mentioned I might also buy UVXY. I will buy UVXY sometimes as a volatility hedge. It's a terrible investment to hold more than one day. That being said, I will hold it more than one day when we have these types of setups. And let me show you why. I'll take you back, make sure I get the right one here. All right. So if we look back in September, this was one of those 50 basis points below. So the SPY was 50 basis points below the 200-day average. Now, if we move forward, and on this spreadsheet, I also measure UVXY. Look at what happens, and this was, I think, 9 days forward. This was a big volatility event. The whole market went down 2.7%. Look at UVXY, it gained 19% in one given day. Now, does it do that every time? No, it doesn't. I looked at some of the other instances. Let me see if I have those numbers. One time it was 5%, one time it was flat, one other time it was 17%. But also recognize that in the middle of that, you have the daily moves. So if, for instance, if I bought it here, I would have the daily moves in UVXY every single day up until we had a volatility event. Is it going to be 19%? Probably not. If it's flat, then I probably lost money in that position. So, there's a risk there, but you can treat it as, I treat it as a little bit of a hedge if I'm trading from the daily trading ideas. Let me stop screen sharing for a moment, see if any questions have come in. Okay, we have a few. Let's see. Anesh, can you comment on Cisco? It's been in momentum with 100% this week, but down after earnings. Yeah, let's go take a look at that. Thanks for the questions. Got some good ones here. We'll circle back to those. We'll go to Cisco first. All right. So coming into earnings, I mean, it was a good setup. And I'll have to check, Anesh, I forget, what was it, down 8%, 9%? Going off memory, down 10%. So down 10% with earnings. It was a positive setup. We had demand. You wouldn't have known this demand figure if you bought it before the close yesterday. But you look at that setup, and that's very, very positive. And I think that's part of the reason why declines would be so difficult, so rough today. If you have sentiment of 10 out of 10 and you have low short volume going into earnings, that tells you that everyone's positioned for good earnings. That's bullish preparations going into earnings. Now that also tells me that there was probably a pretty big disappointment there. If you have big disappointment when everyone's positioned in a bullish manner, what are you going to get? Well, you're going to get Cisco down 10%. So that to me is the Cisco read. It was very bullish going into earnings once again with sentiment at 10 and short volume very low, and it didn't meet those bullish expectations. That's I would not buy it if that's part of the question, Anesh. I don't like buying things after earnings because you're going to disrupt passive investment models for a period of time. Question from Tim, please explain buying on close versus buying pre-market on portfolio changes. Buying on close, you're going to get the end of day reference price. That's the price that passive money is gearing towards. Buying pre-market, it's a little bit like being out there in the Wild West. I don't know. I have a hard time trusting pre-market prices. To me, you're taking a little bit of a chance if you're buying pre-market on the portfolio changes. Sometimes it will work in a very good manner, to your favor. Other times it will work against you. Historically, when I've been in these portfolios, unless that name runs away from me, if something's up 15%, I'm not buying it. If it's just normal trading, even up 1-2%, I'll buy half of my position there in the first 30 minutes or so, and then I'll find another period during the day where I'll buy it. And usually that's towards the close. So hopefully that makes sense. It allows me to kind of average into the position. And I explained it to Barry, when I was doing it, I was doing $2,500 a name. I would buy $1,250 in the first 30 minutes, and then I would just, buy $1,250 at some point later in the day. Candace, yeah, I think I just addressed that question. Good question. How do you recommend buying portfolio names that have changed in price overnight so as not to chase funds that have already risen? There's no hard, fast rule there, but in my head, if a name's gone more than 3% higher in the first 30 minutes, I'm just going to let it go. See if it comes back to me. It might tweak things slightly from the model, but it just doesn't pay to chase things. Question from Brad. From a chart reader's perspective, he likes the market action now. All-time highs on the SPX. We're just grinding higher. As an options trader, it's working well for me. He says, I know Tim doesn't put much credence in Chartist, but it's paying the bills. And I love to hear that, Brad. That's good news. And question or comment from John, I'm assuming that's with Cisco as well. AMAT is very similar with earnings today. So great questions, everybody. Really appreciate it. If you have anything else here, we'll probably take about 6 or 7 more minutes today. Anything else, just let me know. We talked about volatility compression. We talked about the model portfolios. I think I'll just end things here with kind of the look ahead. And I mentioned this at the beginning. It's kind of an interesting setup right now. I'll take you over to our daily look. So in the what you see on the charts every day is a 5-day average. What I'm showing you is sentiment. So you can't make too much out of one day, but we've actually stacked a couple of days here. And what I'm referencing is the fact that on a daily read for sentiment, we actually bottomed a couple of days ago at 5.9, and we're now starting to move higher again. This is the 5-day read that Maybe it gets down to 5.9. I'm not sure. It might just stay here and bottom at 6 out of 10. The reason that I show you this, and it doesn't happen that often, occasionally in the market we'll have what I refer to as a double sentiment top. So, and let me see if I can enlarge this. That's not what I wanted. That's what I wanted. So this is what I mean by a double sentiment top. You have sentiment that starts to move lower and then it starts to move higher again. So normally when we have, here's the norms. Sentiment moves above 6 and it moves back below. But you have these instances where sentiment stays higher. Let me back this up a little bit to the beginning of this discussion. I think I have 5 or 6 episodes here. This one was back in 2018. This was actually the worst performer. I'd have to go back and look and see if anything in the market was occurring there. But we had about a 10% drop in about 9 days. If you look at the rest of these, it was generally constructive for broad market activity. We have these periods where the market trades sideways, very similar to these sentiment tops. Market continues to move higher. That was April 2020. 2023, we have a double sentiment top. Market continued to move higher until the next inflection point, which was month end. Here, double sentiment top. Market continued to move higher until the next inflection point. May 2025, similar. This was a big one that was coming out of some of the tariff tumult, and then the market just continued to rip higher. I bring this up right now because we might be going into something similar at this particular time. I don't know for sure, but if we look at, and I showed you the daily read, could we potentially kind of stop our move lower at 5.9 or 6 and then continue to move higher? If so, that would probably be constructive after a period of sideways trading. So that's part of my look ahead is, that potential double top from a sentiment perspective. I am watching out for volatility. I mentioned that earlier. I think that is a risk. It doesn't mean that the market, falls apart, but you can have those just violent moves lower between 1 to 3%. And that, I can very well see that happening in the next couple of weeks. So that would be kind of my look ahead, is that I think we're flat to up here in the next couple of weeks with some type of volatility event that is likely to occur. And guys, I think that was it for me today. Anything else that I can address before I stop today's recording? If not, I'll go ahead and stop the recording. And as always,